All set? Okay. Good morning, everyone. Welcome. Good morning. It's morning. You know, we don't do housing finance policy events in the morning ever. So this is a new experience for all of us. And hopefully everybody got their coffee. And I think we have a really great program set up and a lot of really good information that will be shared. I'm really looking forward to the conversation as well. My name is Elena McCargo. I'm the Vice President of the Housing Finance Policy Center here at the Urban Institute. Lori Goodman is my partner in crime. All of you know Lori very well. We're excited to get started this morning. Thankful that you are all here with us bright and early. Hello to everyone that is online. We have a nice live webcast going on as well. So we'll try to keep you all in mind as we go through the program this morning. We are, if you are in the room or online tweeting or anything like that, feel free to do that. If you look at your agendas, there are Twitter handles for all the speakers and or their organizations, as well as use the hashtag #LiveAtUrban so folks online can follow the conversation. And I want to just take a minute to talk a little bit about what we're going to do today, kind of lay out the agenda, and then we're really excited too about having the opportunity to engage with the audience as we go through what is, I think, a really important conversation. We've been talking a lot, and there's been a nice body of research and work and testing kind of taking place to look at how to bring more people into the mainstream as it relates to financial products and how to increase financial inclusion. And that conversation's been going on for a very long time, but people are really starting to think about how technology and data and different types of data can really expand or advance that conversation. So we are really excited to talk today about sort of how the inclusion of more consumer financial account data that can identify cash flows, help bring in more customers or consumers who are credit worthy, kind of into the credit visible space from where they may be today, which is sort of off the credit spectrum. And a lot of great work is being done around this by the experts that we're going to have speak to you all today. So we're going to start this morning with a presentation from three experts in this field. David Schellenberger, who's the Senior Director of Scoring and Advanced Analytics at FICO. Nick Thomas, who's the president and co-founder of a company called Finicity. And Mike Pekin, who is the head of data strategy at Experian. They have been doing some really interesting work and experimentation around looking at how additional data sets from consumer transaction data can be useful to the credit process and accessing credit and including more consumers in that process. Then after they're finished with their presentation, we will turn or bring the panel up. Lauren and I will join Lauren Saunders from the National Consumer Law Center. We'll join them on stage to have a sort of moderated discussion about some of the some of the ideas that we're going to be hearing about and some of the conclusions and early results that we will see from the team. So I think I've covered all the good housekeeping stuff. We're going to go ahead and just sort of jump in because we don't want to lose time because there's a big, robust agenda ahead of us. And I just want to remind folks again, if you're online, that you can submit questions on the webcast to events@urban.org anytime during the program, and they'll be filtered up to me so that we can make sure that those are included in the conversation as well. So with that, I'm going to turn the stage over to David, who's going to kick us off, and then we'll join you in a little bit to have a conversation. So thank you very much and welcome.
Great, well, thank you. I guess we'll get mic'd up here. We'd just like to thank the Urban Institute for having us here this morning. Well, it's a pleasure to be here today. As was mentioned, my name's Dave Schellenberger. I'm a senior director at FICO. And I've been with FICO about 20 years. And I have to say, this is probably one of the most exciting innovations that I've seen over my tenure there. we have an opportunity to really change the game in terms of how consumers are assessed for credit risk. And by bringing in different types of data sources. And the opportunity is huge, really across the board, but particularly with respect to financial inclusion. I know at FICO, we have been very focused in on financial inclusion. We have the FICO Financial Inclusion Initiative is something that is focused really globally. Because if we look around the world, there are over 3 billion consumers that are either unbanked or underbanked. About 2 billion of those are unbanked. But we've got about another 1.3 billion that have access to some type of banking programs but have no credit history. And we all know that it's very difficult for a consumer to obtain credit without a credit history. So what we're talking about today really is relevant for that group, for consumers that have some type of banking relationship that may have a checking or savings account, for example, but no formal credit history. So is there an opportunity to bring that information into the mix and essentially assess those consumers with respect to credit risk? And we know that if we can do that, that helps not just the consumer, it helps banks, but really the entire economies of the countries in which they live. So it's very important. And a lot of the work that we're talking about is being informed by events that are happening outside the US. There's a lot of activity that's happening, for example, in the EU with respect to GDPR. And open banking is having a huge impact on what we'll be talking about today. But what we're talking about really is around, is very US-centric in terms of our talk. And we know that there are millions of consumers today that lack sufficient credit history to obtain a safe and reliable credit score, such as FICO score. We also know that there are tens of millions of consumers that have fallen on hard times, that have some type of financial distress. They may have been able to get back on their feet, but the traditional credit information that we have really is not representative of their true risk profile. So is there an opportunity for us to leverage different types of data sources? And these are substantially large groups, about 53 million consumers with sparse data or no credit files. And that breaks in about half, roughly about 25 million consumers are complete no-hits, essentially have no credit file on record. The remainder have either very sparse or very stale information. But if we can pull additional information into play, there's an opportunity for us to generate a reliable score. And again, 79 million consumers that have suffered some type of financial distress, but by bringing in additional information, we can identify those who've been able to get back on their feet and are good credit risks. And as we're talking about this, we're certainly focused in on that group on these two groups that can broaden financial inclusion. But we're seeing that there's opportunities really across the entire spectrum in terms of using this type of data to do a better job in terms of scoring. So I think one of the natural questions that comes out of this is, well, if we're talking about obtaining this type of data, how do you get it? What does it look like? What does data aggregation really mean? And there's no one better to answer that than Nick Thomas. So I'll just pass the baton.
Thank you very much. One of the stories that I like to tell is of Lin-Manuel Miranda. So if anyone has seen Hamilton, back when he had just finished In the Heights, he was 28. He's done well for himself, and he went to buy an apartment, and he couldn't get a loan. So he'd been very financially conservative, didn't have any credit card, had no credit. And so he was, whether he was a no-hit or not, I don't know, but so he had to have his father co-sign on a loan for him, and he's obviously had done well financially. And so that's just one segment that I think can be, and I think all of us have stories of people who have gotten out of college, they get good jobs, they've got good cash flow, but they don't have credit history. 70% of millennials are leaving, coming out of school without a credit card. And so there's a growing group of people who have great cash flow, who are not a credit risk, who should be able to get access to credit, but are not able to today. And so excited about, as Dave mentioned, the use of consumer contributed data for a couple of reasons. One is to expand the credit envelope, but two is the idea of putting the consumer in the middle of permissioning the use of their data in a decentralized way at the time of application for a loan. And that's really what aggregation is. Now, if you're coming at this from a lender perspective, consumers are expecting things to be digital. They're expecting it to be on the mobile phone. They want to be able to apply for a loan very quickly, and they want to be able to permission their data so that that decision can be made very quickly. And so if you look at, in the housing context, if you've done a loan in the last five years, I refinanced my house 4 years ago, and it took me 60 days to go through the refinance. And I had to fax and email and upload documents. And so the time that it took for me to get the data to the lender so that they could make the decision, it took a long time. And so data aggregation, or accessing data digitally, helps to reduce the cost of closing a loan, the time to close the loan. It increases accuracy and improves the security of the data because it's all being accessed digitally and decisions are being able to be made digitally. And so consumers are expecting this to be fast, and that's really what data aggregation does. So a little history about Finicity, kind of the 30-second version, is we started the company probably in the worst time in history in 2000, right at the end of the bust, and had a vision to help people make better financial decisions at the point of sale. We created a product called Envelopes, and it was a PC app that synced to a Palm Pilot. And we knew that consumers didn't want to really enter their transaction data manually, so we wanted to come up with a way to automate the harvesting of transaction data with consumer permission so that they could manage their cash flow better. And so since 2001, when we released that first product, we've been providing services both in terms of tools and education and coaching to help people spend less than they make. And so along the way, we built out over 16,000 integrations with financial institutions to support the automation of harvesting of that data to support that particular use case. Back in 2014, we decided the only thing better than having a leading financial management tool would be to leverage that asset of data aggregation and provide it to others. And so we fuel 4 of the top 7 personal financial management tools in the US. We also provide other products that I'll talk about in a second. But the data aggregation is all about enabling the consumer to permission access to their data, and then we have the pipes. So our integrations are the pipes to enable the transfer of that data from the bank to the consumer's app through us as the pipe provider. So we think of ourselves as a utility for use in different verticals in the market. So some of the things that you can get out of financial account data is we're going to talk about scoring today, but identity, employer, verification of employment, verification of assets. So we've announced that we're a day one certainty provider with Fannie Mae for verification of assets, and single source validation, which is combined income and asset verification using bank data. So whether it's assets, income, employment, identity, there's a lot that this data can be used for, and this particular presentation today is focusing on the credit scoring aspect. Too much information on the slide, but we provide financial wellness tools. So on the right-hand side, credit decisioning, like I mentioned, income, asset, employment, cash flow, and the foundation of credit scores. We provide instant account verification. If you've ever permissioned your account to be used for an ACH, and just regular fueling of PFMs. So those are just some examples of what data aggregation can be used for. And I mentioned day one certainty. So this is a program that Fannie Mae launched to enable digital access to that data, so you don't have to fax and upload those documents. And a VOA report or an asset verification report leverages the consumer permission to go get access to that data and put together a report that the lender can then use to digitally decision on the loan. And that's my piece.
I'll take the baton. So making it real. So I'm Mike Petson, actually, from Experian. Nobody gets my name right. People change it to pecan. They do a lot of things, but they don't get it right. I'll echo what Dave said. I've been either in financial services or financial technology for I hate to say this, like 28 years. It's been a while, and I've seen it from different sides. I've worked in the direct-to-consumer space, in credit. I've been a teller at a bank. I started in high school as a teller at a bank. And now I sit with Experian, and I head up data strategy, focusing on alternative data strategy and other strategic initiatives. And when I say I echo his sentiments, I haven't seen anything that has had the opportunity to move the needle in the way that this can. And on one hand, it's very interesting to me because, we're talking about bank data, right? So Nick has walked us through aggregation, the basics of aggregation and how it works, and the fact that from bank data, you can determine all these things. You can look at income, you can look at assets, you can look at identity, employment. And so this data has actually been used on one hand for quite some time. So when I went through and did my mortgage a couple years ago, it was a little bit better than Nick's experience. I didn't have any faxes. I did have to not email because that's insecure. It was upload to a secure environment a lot of documents, and there were a few extras. But they wanted my bank statements. They wanted to dig in a little bit deeper because I had just switched jobs. And even though I was in the same space, they just wanted a greater view of what my income, what my cash flow looked like. And so lenders have used this data when they've needed to, when a certain threshold was not met or they wanted to peek a little bit deeper. And so they're very familiar with this data on one hand. But one of the nuance that's important is, of course, it wasn't very accessible. Me having to go and either find 12 to 24 months of statements or dig them up and bring them into a branch is very inconvenient, number one. And number two, it doesn't really allow for the full appreciation of that data, because then that means someone's going to have to manually enter everything if they really want to appreciate every line by line, right, and parse out some of the pieces Nick talked about. And so with aggregation, that really sort of opened the floodgates where, again, it became something that was more seamless, and the data could be used, right? It was like the freeing of information where it could be used in more meaningful ways. And so how do we make it real? Well, I think there are three tenets that makes it real for the consumer, right? So we're talking about consumer permission data. The consumer is in the middle of this equation, and you're asking for the keys to the kingdom, as it were. So you're saying, hey, put in your, identify your institution, put in your credentials, and identify the accounts you want to permission, right? And so, no surprise, what we've been asked many times is, okay, well, how do you get consumers to do that, right? You're asking for quite a bit. And so there are three principles. So the first one is just guide them. Let them know actually what's going to happen. What we saw early on when these implementations were put in place is that there wasn't a lot of context or proper context around, what was happening, why it was happening. And of course, that meant that the consumers weren't necessarily completing this process. So you really want to guide them and be very explicit and very upfront about, what the process is and what's going on. The second thing is entice them. Don't overpromise, but entice them. Let them know what the benefits are. And so, as Nick started to say, or as he said, it started with personal financial management solutions, PFM, this technology was used so that a consumer could permission their data, and you would get, the value of seeing all of your accounts maybe in one place, like an app like Mint, if anybody's seen Mint or another personal financial management app. And so there's value there, okay? When we moved to day one certainty, what Nick talked about is that day one certainty, is a time savings for the consumer, because again, I didn't have to go and pull out all those statements, right? I could easily permission my data, okay? But now what we're talking about, I think, is sort of the next level. I think this is sort of I don't know if it's the end all be all, but it's definitely the next level. And that level is that the consumer could benefit by having, greater access to credit, right? Because what we're talking about here, just to be clear, is that we're taking traditional credit data, so you've got your credit report, and taking, the electronic version of bank data, and being able to appreciate both of those data sets, right? So the traditional data is the propensity to pay, will you pay? And of course, the bank data is, can you pay? Those are the two major sides of the equation. And so in this case, and I don't want to steal too much of Dave's thunder here, but in this case, what we're talking about, the enticement is, if you did not qualify, right? Because maybe you had that thin file, maybe you had, you were a no-hit, that with the inclusion of bank data, you can be appreciated, you can get greater access. And to me, I think that is one of the most enticing things, one of the biggest value you could present to a consumer, where also they have control because they permission the data. And then building trust. I mean, it goes without saying, I could really distill these three tenets possibly into two, which is, trust and incentive. So if you're guiding them properly, right, and you're presenting an honest, incentive to them, and you're doing it in a secure way where the consumer is in control because they permission the data, you're going to build trust. And that is necessary, for this to take place. So I won't spend too much time on integration. This is a little bit more of a technical slide. But what I will say, I'm going to deviate just a little bit, is on the note, again, of trust, incentive, and guiding the consumer. In my role, I've been looking at data. I've been looking at traditionally furnished data that's alternative. I've been looking at consumer permission data, all different, data types. And that's really been a part of what we're trying to do as well, what our mission is at Experian, which is to be the consumer's bureau. And so, to me, this is perfectly in line with the capability that Finicity has in us coming together. Just to touch on integration just a little bit. So the way it all comes together is that lenders, will leverage a Finicity hosted, what we call widget affectionately. And the consumer, I described the consumer permissioning process, but lenders, they don't have to do, the coding directly to APIs. You see APIs up here. They can invoke this widget, which takes the burden off of them, and it controls that consumer experience in a very secure way. Well, Finicity has mastered that. And when I talked about what's necessary for consumers to complete the process, we're seeing consumers go through at a rate without the FICO score and the additional access to credit being anywhere from 75, even up to 85% if a loan officer is involved in that process. We also have a fully hosted solution, and what I mean by that is that, if, as many companies, they don't have the time or resources to do really any work, we can create effectively an entirely hosted, branded solution for that lender to ease the burden. So what does it mean? So obviously it means that we're going to be delighting the customer. The customer or the consumer has improved visibility into the process. They are now a part of the process. You're offering them up. You're saying, hey, we may not have been able to qualify you otherwise, but now we can qualify you, or it has that potential to really expand and start to include those invisibles. And then, of course, for the engagement itself, it just empowers the consumer. So again, the consumers are delighted. It's a win for the lenders as well. So I think with that, back to Dave with some of the nitty-gritty.
Great. And I just wanted to share with you, thanks, Mike. I wanted to share with you just a little bit of the research that we've done before we start the panel discussion. How do we go about developing a score like this? And the research that we undertook, essentially we took a very large data set, over 35 million credit files that were de-identified, and merged onto that data set checking and savings account information, or demand deposit account, DDA data, essentially is what we're talking about. So when we talk about this additional consumer contributed data that is augmenting a FICO score, we're referring to checking, savings, and money market account information. What we're able to do is essentially look at this type of data, the checking, savings, and money market information, in addition to the traditional credit information. And then essentially the technique that we used adjusted the FICO score. So as we look at the credit risk that is demonstrated by the FICO score using the traditional credit information, by bringing in this DDA type information, we're able to adjust that FICO score. And in circumstances where a consumer has no FICO score, we're able to build out a separate score that leverages this type of data in addition to whatever sparse or any other type of credit data may exist on the credit file, even though it may not be enough to generate a FICO score in and of itself. So we replicated this process. And one thing to point out, I think, is we're talking about transaction data. That transaction data can get very granular. And one thing that we focus in on really are things such as how long an account has been opened, or how many accounts an individual has. What we're not interested in, for example, are things such as what did the person write a check for? We don't care if the check was written at a liquor store or for a church donation. We're not interested in that level of detail. What we do focus in terms of this early research really can be broken down into a handful of categories. We're looking at things such as the length of a DDA experience. So how long has someone had experience working with that particular lender or that particular banker? We're looking at the thickness and composition of the file. So does this person have a lot of experience in terms of managing checking and savings accounts? We're looking at usage and activity. So how often does this person write a check, for example? So we're trying to get a sense for how much experience this consumer actually has in terms of managing these relationships. And then we're starting to look at capacity. So what's interesting here is we're looking at things such as balances, and more importantly, we're looking at money coming in, for example, to a checking account, money going out. And if we see less money going out than what's coming in, we can surmise that there's savings taking place. And finally, we're looking at presence of negative information. This tends to be pretty predictive. Does a person bounce a lot of checks? People that bounce a lot of checks tend to be higher credit risk. So looking at our data, what we saw relationships that are pretty intuitive, but we're able to empirically define these with the data that we have. So for example, people that have long, well-established relationships with respect to their checking, with their lending institutions, with respect to checking or savings accounts, tend to be better credit risks. What's nice about this, though, is that we can look at this across a wide array of different consumers and empirically determine what the length of that DDA relationship, how that correlates to how they'll perform on their credit obligations. And that is enabling us to pull that information into a national credit scoring system such as the FICO score. We're looking, for example, at ratio of total debits to total credits in the last 6 months. So we're looking at money coming in and money going out. And again, if we see that there are instances where everything that comes in goes right back out, where there's very little savings, that tends to correlate with higher risk versus someone that is taking money in but is savings, that they're able to save a little bit each month. And we see that that is correlated with lower risk. So a person doesn't have to be a millionaire, but if we see this type of behavior, that does tend to correlate with better credit risk. And that's something that empirically we can demonstrate. We also are looking at things such as presence of negative information. So we're looking to see, has a person bounced a lot of checks recently? And we do see that people that bounce a lot of checks tend to be higher credit risk than those that don't. And again, we can correlate this directly to credit risk. Now, does that mean that if I bounce a check, am I going to get dinged entirely on this score? No, because we're looking at a variety of different types of variables, and we're taking them all into account. So we're not putting all of our eggs in one basket. So this essentially is how we're leveraging this type of information. And what we tend to see on total is that people that are willing to share that information tend to get higher FICO scores. In general, people that have better, they can demonstrate strong management of their checking or savings account information, tend to be better credit risks, and we tend to see overall a shift upwards in terms of score distributions, which is a positive. So just in summary, I think we're very excited about seeing the opportunities of using this type of this data. We see that overall there's a net positive effect for populations when we're able to incorporate this type of information and merge it with traditional credit information. And I think that the net effect is ultimately going to allow us to broaden financial inclusion with respect to a scoring system. So with that, we'll wrap up. Thank you.
Thank you, guys. Thanks. Okay. I always speak loudly.
For stats.
Thank you for kicking us off with that presentation and sort of laying some of the groundwork on the conversation we want to have about this opportunity for consumer permission data. I would like to first, start with just a few questions around where this project or where this idea is, just to make sure everybody's kind of clear on, is FICO already using this in real time? Has there been some testing done in real time? Just to give everyone a sense of, it's a great idea, but where exactly? I know you've been doing research on it and looking at the empirical analysis, but where is the application of this at this point, just to make sure everybody understands.
Sure, and that's a great question. Yeah. So we have, to your point, we've done extensive research on this. I think we've established that this approach has a lot of validity, and we're in a process now of creating a pilot program. So we're expecting to launch the pilot towards the end of the calendar year. We're currently in discussions with number of lenders. There's a lot of interest in this, and we're expecting to go into a pilot phase at the end of the year and then make it generally available in 2019.
Great, thanks for clarifying that. I just wanted to make sure everybody understood. This is really incubating, so this is a conversation that we're having before there's really, which is a great time to have the conversation, to hear all the types of questions that will come up as the details, as you sort of get into the layer of details around how something like consumer permission data would actually work practically, what are the regulatory implications, who is left behind even as a result of bringing in this kind of data. Those are the kinds of things at the Urban Institute that we would care a lot about and want to ask questions about, and I want to give Lauren a chance from the National Consumer Law Center's perspective, given the work you all have done so deeply on the credit issues, hearing about these kinds of ideas around bringing more transaction data and deposit account data into the credit spectrum for the purposes of financial inclusion. I'd love to kick off with you giving kind of a perspective on what you just heard and some of the points that you think are probably most pressing that this audience will be interested in. So Lauren, I'll turn it over to you.
Sure. At the National Consumer Law Center, we work for economic security for low-income and vulnerable consumers, underserved consumers, and really want to make sure that people are getting fair, affordable financial products and are staying away from the ones that are leading them in the wrong direction. And in the credit space, obviously, ability to repay is really the lodestar for us. Are people getting the credit that they can afford to repay? And are they staying away from predatory products that are pushing them into a deep hole? And across the different credit products we look at, that is constantly an issue that we are pushing. You need to truly assess somebody's ability to repay. And when we do that, residual income is often the lodestar, the gold standard that you really want to get at. Now, you can't always do that in detail in every kind of credit product. Certainly, credit scores work well, for a lot of products and a lot of consumers, but they are in some ways a crude tool. And really being able to assess, is there money left over to pay, this credit at the end of the day is what we're really trying to get at. So bringing in that actual data that answers that question, certainly at least from a very near-term historical perspective, can be very helpful at achieving what we are really trying to achieve when a responsible lender does underwriting. I worked on the payday loan rule at the CFPB, a market that obviously is notorious for not caring whether consumers can afford to repay their loans, and because of that, the Bureau felt it had to be particularly detailed in mandating what had to happen. And one of the questions we were asking ourselves as we assess the proposed rule is, okay, you've got the income and you've got the looking at a credit report, but clearly there's a lot of basic living expenses that don't get covered in a credit score. What is enough? What do they need? What are they paying for childcare and for food and for just the day-to-day expenses? And that's something that typically is not assessed. Even on a mortgage application, you don't come up with a detailed budget, but understanding more what people's day-to-day financial picture looks like really gets you much closer to that question of, can you afford this credit product or not? So, as a general matter, we do support the idea of bringing in consumers' transaction data on a consumer prediction basis, and think that it can really get us much closer to that really true affordable question. It obviously also deals with that catch-22 of credit of, well, you can't get credit unless you've had credit. I spoke at my son's high school financial management course a year or so ago, and the teacher said, now I recommend that you all go out, and this is, we're talking 16, 17-year-olds. I recommend that you go out and get a credit card so you can start to build your credit. And I said, no! I said, no, right now the most important thing is for you just manage your money and learn to spend what you have, and credit will come. And obviously I'm in Bethesda, so this group is probably not going to work, have trouble getting credit down the line. But nonetheless, I said, don't worry about becoming visible right now. Worry about managing your money. But nonetheless, for a lot of people, there is that catch-22, and certainly for that kind of thin, no-file group, this can be very helpful. And I also hope, and this probably remains to be seen, that looking at this individualized data will help to mitigate some of the disparate impacts that unfortunately are still in the credit scoring world. We know there's been a lot of effort to get them out, but we know that there are differences in how credit scores work for different groups, and it remains to be seen, and we have to pay close attention to how this works. But that is one hope I have for use of this data. I do have a number of questions, and this is, I'm sure as the experiment goes on, we'll get answers to some of these. How is this going to work for consumers who use prepaid accounts? Do they perform differently? Are there, just operational differences in how you access that data? Certainly there are people who are staying away not only from credit, but from traditional checking accounts for good reason. We want those people to be part of the financial mainstream, and there's no reason that their transaction data couldn't be treated, analyzed in a very, in the same fashion, but there might be differences between somebody who's chosen a prepaid account or has been kicked out of the checking account system. So we'll have to look at how it works for that population, but it's a very important population. How does this work with income volatility? I know your slides are probably simplified for what you're actually analyzing, but we don't care just about the average over 6 months. We care, are people going to be able to pay every month? And or maybe somebody had a hit in the past or a hit in the future, and how do we build all that in? And I also think it'll be interesting to know, how long do people need to recover after an income or expense shock? That's a question that we're often asking ourselves, because we know volatility is increasingly the norm for a lot of people, and not the exception. Now, of course, today we are talking about a narrow, particular use, consumer permissioned, only for the purposes of granting credit for people who would otherwise have been denied, only looking at the amounts of the payments or the expenses, and not whether you shop at Walmart or Nordstrom's. But I also have to ask, where is this going? Not just for the companies on the stage, but for the whole world of people who might access, transaction data. And those are things that do worry me. The data is there about where you're spending the money, and we've definitely got to worry about the disparate impacts of the judgments that might come from associations from where people are spending their money. At some point, I think it's likely this data will be used not just to grant credit to people who are being denied, but to deny people or to price people at higher rates. And we've got to ask the questions in that context. Now, denial of credit is not always a bad thing. I mean, in my world, I'd rather have somebody be denied credit that they can't afford, and obviously we want to make sure that people who can afford it are getting. Nonetheless, there are a lot of complicated questions there. There are the FCRA issues of giving adverse action and telling people why they were denied or why they were priced higher. And so those are going to have to be built in, if that becomes the norm. We also are talking about consumer permissioned, but I can certainly foresee a world where you don't really have a choice about whether you give that permission or not. Today if you want this credit product, you're just going to have to click I agree. So we've got to remember that overlay. And then not every company is necessarily going to hold the data in the same secure way that we probably can trust the companies here on the stage. We don't know if they're going to sell it. There are privacy issues, and there are how long does the data aggregator hold on to the permission? Do they just access your account at the moment of a credit decision, or do they keep that permission going a lot longer than they really need to for the immediate purpose that the consumer agreed to? And I think those are already issues in the data aggregator world. I'm not commenting on these companies or this product, but those are the kind of questions that that I ask. And I've also already seen some company. Just yesterday I saw a payday lender who makes loans at 100 to 400% APR boasting about their use of bank account transaction data as part of their underwriting model. And sometimes they're looking to make sure the person can pay long enough to make the loan profitable but they don't necessarily care whether they're going to get to the finish line from the consumer's perspective. So, it's always my role to look at something that looks great and new and shiny and a lot of promise and a lot of really positive aspects of this kind of data, but we have to keep in question the larger issues that are down the road as well.
Well, that was a lot of great things to think about. I want to give Mike and David and Nick a chance to sort of respond to some of the ideas that Lauren just mentioned initially before we jump into other questions, because you asked lots of questions, lots of very, very good questions. So, Mike, do you want to start?
Yeah. There's a few things I'd like to address or speak to. So, I think one big aspect you talked about FCRA, and of course Experian, is a national, credit bureau, and because of that and our experience, everything that we do so very thoughtfully in terms of, data quality and how what we're doing, could affect the market. And so when we actually partnered with Finicity back in 2016. So again, we talked about the reports. Specifically, there's a verification of income report and a verification of asset report. Those are in market today. So while this new score, again, that we're talking about, we'll be piloting later this year, experience with Finicity and their data and bringing it to market and doing so in a way that's fully FCRA compliant, we already have that experience. And the way we support the Finicity, what I will call reports today in the verification of income and verification of asset, is virtually identical to the way that we would handle your credit report. So what I mean by that is this: if you are a lender and you purchased a verification of income report or verification of asset report from Experian, of course the consumer permissioned that, they go through the process. But let's say the lender says, well, based on data provided by Experian, we needed to decline you, right? We couldn't approve you. And so that consumer has the ability to contact our national center, whether they call, whether they mail, whether they email, just as they would for a credit report. Our agents, just as they would with a credit report, would walk them through the information that is there, right? And the consumer would have an opportunity to dispute or challenge that information in the same way they would with a credit report. So that is one of the sort of the cornerstones of being FCRA compliant, is that you can support that process. And so, of course, when the consumer does that, we're going to say, okay, when the data was aggregated, was there any mistranslation of that? Can the consumer provide record, that it is incorrect? An example that I give that I haven't really seen in a long time, but one that you could foresee happening. Maybe the deposit was $1,000, but the bank truncated and it was only $100. Okay, so we're going to facilitate that whole process and bring it to closure, just as we would with a credit report. And of course, Finicity as well is a registered CRA. And so that's different. We talked a little bit about account aggregation and how that works. There are other providers out there, just as there's other bureaus, so there's other providers of account aggregation. And when we looked at who we wanted to partner with, Finicity was the clear choice, because of their commitment to quality and specifically to this FCRA. They registered as a CRA. And so we felt that the T's were crossed, the I's were dotted, and ultimately, in addition to just being compliant, we knew that we were going to bring a higher quality product to market with less issues, and it was going to be fully compliant.
Great. Do you want any follow-on questions? Go ahead. Yeah, absolutely.
Add to that. So while we're talking about FCRA, that's one thing. A FICO score, of course, is developed to be FCRA compliant as well, and that means that we return reason codes, score factor codes as well. So just as we return score factor reason codes with respect to traditional credit, we're also engineering factor codes that refer back to the DDA data. So just as Mike mentioned, if a consumer has an issue, if they feel that information is incorrect, we're facilitating the means to provide transparency for that consumer to understand where they may be getting denied. Now further, we're actually taking a little bit of a different sort of turn on this. And traditionally, under FCRA, we have to provide reason codes with respect to adverse action. But we're also providing positive reason codes as part of this, which illustrate the good things that a consumer is doing in terms of managing those accounts. So for example, hey, you haven't bounced any checks over the last 12 months. That's a good thing. We see that you're saving money, or there's evidence of savings here. That's a positive thing. So part of what we're trying to do as well is educate consumers in terms of positive habits that reflect well in terms of risk assessment.
Okay, thanks for that. So one of the things that you first mentioned, it was your very first slide, Dave, talked about facilitating credit access for 3 billion consumers globally that are unbanked and underbanked. And as you've kind of gone through this, I've sort of heard, and just want to make sure I understand it right, that the consumer has to have a financial account, give permission to use that financial account to the financial institution, and then I guess the financial institution also has to agree to share that data with the credit reporting agency. So when I think about unbanked, and I'm just sort of thinking about the universe that's served by the solution in its infancy, can you, or Nick or Dave, just kind of talk a little bit about how and who really is served by this, and especially when you think about the unbanked who would not have transaction data for you to look for. And then I want to talk a little bit too about the power consumers have to, and who will agree to have this done and who won't, and then how does that sort of create kind of a new dynamic of bias and other things in the system. So maybe Nick, it's for you.
Yeah, so in 2016, the FDIC released a report about a 2015 study on the unbanked in the US. And they determined that 7% of the US population was unbanked, which equaled about 9 million households, translating into about 15 million adults in the US. And so that particular so that means that 93% of the population is banked, meaning that they have a checking or savings account or both from a insured financial institution. So Finicity, as a data aggregator, we also support the bulk of prepaid cards and can aggregate prepaid card programs in addition to traditional bank accounts. And so this has the potential of scoring both prepaid as well as traditional bank accounts. So if you think about the 53 million that Dave talked about as thin file, no file, and you subtract the 15 million adults in the U.S. who are unbanked, that leaves about 35 plus million that are in the unscorable category that have a bank account. And so think about inclusion relative to, of those, how many are managing their money in a way that could generate a positive score. That gives some context as to the potential impact in the unscorable space relative to those that are banked but unscorable.
Interesting, okay. And so on the question of the financial institutions' willingness to share data, can you just touch on that a little bit? Because I think if that's not part of the consumer's option, how do you do this in a way that's...
Yeah, so we've been aggregating data for 18 years, and generally speaking, financial institutions are in favor of consumers being able to get access to your data. I mean, you should be able to go download a statement. Financial institutions have supported delivery through OFX and other standards of data to a consumer's personal finance app. And even in Dodd-Frank Title 10, Section 1033, it says that the consumer should get access to their data electronically, and banks should make it easy for consumers to get access to their data. And so I think the ship has left the station relative to consumers ability, and that they should have the ability. And we've seen a strong willingness from financial institutions to enable consumers to interact in the world of fintech or in the world of lending with their data. We've not really had a lot of issues that way. And part of that is because we've been at this for 18 years. We have both formal and informal relationships with financial institutions who are supportive of consumers accessing their data, as long as the consumer is permissioning it for their use.
And and this really goes to something that Lauren sort of brought up, but for those that are sort of not using traditional banking services, payday loans and other types of credit products that they may be using that are sort of not traditional. The sort of idea that some of those institutions or those types of credit models would be willing to share, are willing to share for those who have been traditionally sort of underserved, underbanked, and sort of using non-traditional products. I just wanted to kind of get a sense too of your experience with them and how you think about bringing them along as well, so that we can bring more people into the traditional mix.
So as I mentioned, the most important part is that if you can assess ownership of that account, then you can take the data that's included in that account and make decisions based upon that. So if you're getting a direct deposit, or let's say you're part of the gig economy and you're getting paid from Uber, on a periodic basis, and even if that income is variable, you can see consistency month over month. That this over the last 12 months, this consumer has made about this much money, and so you can kind of set a watermark and say, okay, we can generally expect this going forward. It is the fact that an institution is a insured institution versus a prepaid card. You can get the same kind of data regardless.
And one thing I wanted to add, because you had brought that up about gig economy as well, and fits and spurts, and maybe they can pay this month, but maybe they won't be able to pay the next month, I think is what you said, because of those fits and spurts. And so, and I don't want to speak for Dave here, so I'll let him get into the nitty-gritty, but the way I understand it, right, so again, the analysis that was done, when Dave said that it was empirically validated, it wasn't just intuited that, okay, someone has bounce checks or someone has good cash flow, so they're going to have a higher credit score, or they're going to be less of a risk. So again, it was both sets of data that were analyzed, meaning you analyze the cash flow and you correlate that, even if there are fits and spurts, you correlate that to the performance. How did somebody perform with a given cash flow? So once you have that empirical understanding, right, you can say, okay, well, if then this is the way someone has their checking account behaviors and how it correlates to their performance. One, even if they don't have credit performance, you can reasonably assert and empirically, and this is what this gets to, that they're going to behave in a certain way, right? Because FICO did that analysis. The other thing is this, and this is why, to me, it's the two major sides of the coin. I mean, you will see people that maybe they do have stress in income, but maybe, there are people that are more resilient than others. It didn't follow through that, they were late on their payment. And conversely, of course, you can see people that have a lot of money that maybe they just didn't care, or maybe they don't stay on top of it. But I don't think it perfectly answers what you're saying. At the same time, I think it does go a long way towards addressing that, because again, there can be fits and spurts, but if the proper analysis is done, and I know Dave does these analyses properly, you can say there are fits and spurts, but given all the other characteristics that we looked at, this type of person pays, and so therefore, we would adjust their score accordingly. Am I off in that, or is that?
No, that's exactly right. And you raise a very interesting point about this sort of how we address some of these waves, essentially, in terms of income. And that's something we're very cognizant of. And it's interesting, one of the reasons why we do look at averages, for example, as opposed to points in time, is that we feel that there's the potential for negatively impacting, for example, seasonal workers. And if we're looking at just very narrow points in time, we're actually not getting as good a signal as we do when we look over longer periods of time. So it's a bit of a trade-off. I think it's something that we have to find the right sweet spot there. But that is something we're mindful of.
I have a question about the slides you put up about the factors you look at. Well, let's pick, for example, overdraft fees. Look to me like actually a fairly strict, I don't know, metric or criteria. It's not until you've gone a whole year without a fee that it turned positive, or that risk changed. And of course we know that too many financial institutions, there are things done to encourage people to incur overdraft fees, and obviously if you're getting a lot of them, there's a lot going on there. And we need to fix that whole issue. But setting that aside, is it as simple as it looked up there, that you really need to go a whole year before you're not going to be dinged for that, or is there more subtlety behind that slide?
There's a lot more subtlety, actually, and that's all relative. There's no absolute, good or bad.
Is it different across different credit scores? I mean, if you've got, a 670, you might expect,
It can vary a little bit. So, for example, someone that has had a overdraft in the last 2 weeks is twice as risky as someone that had an overdraft or NSF in the last 8 months ago, for example. So we're seeing this time difference, but it does vary a little bit from various different groups. We use a segmented system, so we will look at thin, young files, people that have very sparse information in their credit file differently than people that have very thick, mature files, people that have long, well-established credit histories. So there's no hard and fast cutoff on that one.
One of the things that I'm excited about is that you look at the amount of education around credit that's happened over the last decade plus with consumers that are thinking about watching and actively trying to improve their scores. I believe with cash flow underwriting and cash flow being included, that it will create a revolution in this country around financial management, and that people are going to think about their checking account, how much they're saving, think about NSFs and overdrafts differently, because it will impact positively their credit score. And so having come from and being in the direct-to-consumer personal finance space, I'm very excited about the revolution in financial management that will come as a result.
Yeah. I mean, the power of cash flow data, I think, for underwriting purposes is interesting. The commingling with scores is another interesting kind of phenomenon. Is that, one of the things that struck me was just thinking about, historically and what we know about credit scoring, sort of the compilation of history and information. One of the questions was really around sort of with that type of data, how long can it be used? When you're giving permission, how long can it be used? How long does it stay on the file? And then I'm assuming, if Experian and the large credit bureaus are starting to collect that and have that as part of history, then obviously it's useful for other purposes as well, for not only credit scores but other things. So just interested in hearing your thoughts and sort of as this evolves, how do you, when permissible use comes up, when the consumer is giving you permission, how long have they given you permission to use that data? What other things can you glean from that data? Looking at sort of the habits of that person, et cetera. So I just would love to hear particularly your perspective from Experian's standpoint.
Sure. So, when we were talking about FCRA compliance, again, you've mentioned permissible purpose, and that's another cornerstone. Mm-hmm. Is that, any party that has access to credit data and obviously what we've described now is both of these sets are credit data.
Right.
That there is a permissible purpose. And so, the great thing about this process, again, is that the consumer, when they go through the process, it's right in front of them. It's called written instruction. What's happening, why it's happening. So that's why I talked about guidance. So guidance just isn't, hey, we need some information from you, for a loan. Guidance, of course, is more explicit. FCRA says that the language needs to be clear and conspicuous in terms of, what the consumer is giving written instruction for, right?
Right.
And so the question, about, does the consumer, well, the consumer knows. The lender, of course, has given us an explicit permission, whether it's an extension of credit or whether it's for account review. So in the case, let's take those two cases. If we take the case of extension of credit, which is primarily what we've been talking about today, the way that works is the consumer gives their permission, the information is aggregated, the score would be rendered, would be passed back to the lender, and then that would be the end of that transaction. Right, so meaning the lender would then say, I am done, and at the point the lender says, I'm done, then there's no more aggregation happening, right? Because that report has been generated. Okay. Now, in the case where there is an account review permissible purpose, so let's say that a lender extends credit to a consumer, and they say, we'd also like to occasionally pull your information, right, so that we can review your account to make sure that you're in the best credit product possible. So account review is a normal process for, say, credit cards. They will pull your credit report, they will look at it, and they will say, does everything look okay for this individual? And so that is a permissible purpose. In that case, the aggregation would continue as long as that consumer, again, explicitly consented to that account review purpose, that permissible purpose. So again, all of the actions, all of the permission that a consumer is giving are tied to, and there's more than just account review and extension of credit, but they're tied to the FCRA purposes, and that's, of course, stored on our end, for the normal, audit purposes, or when a consumer comes through, they would be able to see that on their report, who they permissioned it to, and they would be able to get access, to a report, like I said, for dispute purposes, for any reason.
So just to make sure I understand, so once that information has been pulled for these permissible purposes, is it or is it not then available to some other creditor in the future who also has a permissible purpose? It's now in the is it now in the credit file?
Is it part of the reported history of that credit in that credit file from your point of view?
So the way it's set up today, the way we're going to market is that no, it would be for each lender, right? Each lender would have to have a separate permissible purpose and get that permission from that consumer before they could see. So if I'm lender A and I got permission from the consumer for extension of credit or account review, right, I could access the information as appropriate. But if I'm lender B, I can't just send a request in to get that information. Lender B would have to have, one, the permissible purpose to do so, and two, they'd have to have the explicit consumer permission as well. They can't sort of ride on lender A's permissioning of the data into any sort of central location where it can just be re-permissioned without that consumer being in the middle of it.
Interesting. Okay.
Today.
Right. I mean, right. But that's that's when you think about thin files, thick files. It's just are you building a thicker file for people that can then be used in the future? And I just think that's certainly one of the things to we'll continue to think about as this evolves.
Again, I think these are fascinating questions, and that you ask, and they're on our mind as well, of course, which is with these additional data points, again, that can lead to greater precision in terms of determining someone's risk, right? At the same time, because it's permissioned or because there's more data, it could be used by lenders to make decisions that are less savory, right? Like you said, the more information a predatory lender has, that
And
so-
they're looking at ability to collect more than ability to pay, and the same data could be useful for that.
Sure, and the same thing with, again, when I say today, this is the plan. We've gone to market to say, we're going to be as explicit as possible. And you said I could see a future where consumers don't permission. And I don't know if that was a part of what you were saying, but I always
Or
see,
don't have a choice about whether to permission.
Okay, I always see, in consumer permission data that the consumer is going to be at the forefront, and it's really just going to be about what the consumer wants. If the consumer wants a one-time pull only for extension of credit, that's what it is. If a consumer wants to permission it a little bit longer for an account review to receive benefits, the consumer is going to be in control of that. If the consumer wants to say, hey, build my file, right? I could see that the consumer is going to have the power, but it's all to me about the consumer. I see the legislation. We didn't talk about it. Nick alluded to it, but with GDPR over in Europe and PSD2, which is about data privacy. I'm from California, where we ran a law through its law. It takes effect in 2020, which sort of mimics GDPR, which these laws are all about the consumer privacy rights. The rights not only effectively they have to data, but the rights in order to sort of secure their data and the fact that it is their data. And so to me, this is the macro that's happening, that's pushing us in this direction, for the better. Yeah. And so that's why I feel so positive about it.
Well, and I got to say, it's interesting to see what's happening in other parts of the world. So as Mike alluded to, GDPR, for example, and what's going on in the UK, it creates some interesting technology challenges. Because now we're looking at this whole notion of consumer consent and consent management. So for example, in the UK, if you're providing your bank information to a lender, you tell them exactly how they can use it and for exactly how long. And after that expires, that has to be cut off. So somebody has to manage that. I know Nick's been pretty active.
So in work with the industry on standardization, consent management, and being able to by use case profile define how long that data can be accessed for, what data elements should be available for that particular use case. This is all part of the standardization effort that's been happening for the last couple of years. And so really with an eye towards both consumer control, consumer privacy, and data minimization, data traceability. Those are all principles that are being incorporated into the standards.
Yeah. So go ahead.
I was just going to ask to clarify, by minimization, what do you mean by that?
Well, data minimization is that only the data that that needs to be used for that particular use case is permissioned for that event.
But we know that even today, in some other data aggregation context, that's not always happening. The data may be much broader and much longer than is needed for the immediate purpose.
Right. So we're going to come to the audience for questions, and I want to remind everyone that's watching on the live webcast, events@urban.org is where you can send your questions, and I'll get them up here so we can include them. You guys went to the kind of where my last question was going to go around, it sounds like fundamentally trust is a huge issue. Consumers need to trust that what is happening is going to work for them in a positive way and understand the incentives of that. With recent vulnerabilities in systems like credit bureaus and employment breaches, retail credit card, data breaches, data being shared and sold on social media habits, all kinds of things that in this environment and world that we live in, consumers are getting less and less trustworthy of anything, let alone their what they're posting on and pictures that they put up, let alone financial data. Because trust and permission from the consumer is so critical. How do you think about overcoming some of the negative perceptions and fear that consumers have to trust institutions to use this data in a way that isn't harmful to them and that really truly is trying to bring them forward? I just wanted to kind of sort of throw that out as my last question, because I think the issues of security, privacy, all those things are just paramount at this point in time.
So all of the technology is available today to be able to create an ecosystem that consumers will trust. There's a lot of different pieces that are coming to the table that have been part of the discussion. So whether you're talking about consumer data wallets and the idea of the consumer controlling their own data and owning their own data specifically. We talked about traceability and consumer consent and consent management. Standardization not only of the technology and the use cases, but certification of solutions that are using that data according to a bright standard around how that data is to be used, and companies signing up for using it in only that way. So there's a lot of moving parts. It is happening in the industry, and over the next 6 months, you will see more announcements come out about how those standards are evolving. But the industry is coming together. Cordray in 2016 at Money 2020 it was really the first foray into consumer access to data, recommended that the industry needs to get together and create standards. And that is happening, and it's very exciting, and it will really create a data revolution to fix some of the dysfunction that exists in the industry today through increased control, increased privacy, and really permission and consent management.
Oh, go ahead.
I was just going to say, I guess I come at it from somewhat from the opposite end, that I worry that consumers will be too trusting and won't really know who they can trust. It's, we can't really count on consumers to be able to distinguish between the trustworthy companies that are going to follow, strong standards and the ones that won't. I think ultimately we may need some sort of regulation to level the playing field. I don't think we necessarily know what that might appropriately look like at this point. But I don't think we can really count on consumers to understand, discriminate, even necessarily access tools that might be available for some of us more sophisticated types. But is everything going to so fast and things look sleek and shiny? That can overcome a lot of, unfortunately, hesitation.
Yeah, and I don't disagree with that. And I would say that it's why I started and why I've spoken to, again, FCRA. I went right to the FCRA question. So there is regulation today, right, that provides for rules in terms of how consumer data, how credit data needs to be treated. And I'm not saying it's, maybe it's not fully comprehensive of now this new data type or this new way of accessing data through consumer permissioned. But again, at the core of it, that is what this data is. And so, there are regulations. There are regulators that enforce these regulations, auditors that come into to the bureaus, and that they look at what we're doing. They make sure that we're compliant, that there is transparency, and ability for the consumer in terms of recourse. And so that's why I was saying that we're going to treat this the same way. Now, I certainly believe that we need to do a better job. When I said that our mission is, to be the consumer's bureau, that means we need to do a better job of instilling the confidence in the consumer. That's why my slides actually spoke to, guiding them, enticing them, and ultimately building trust, because we know, you're absolutely right, that is sort of the fundamental piece. And to me, and I don't know if ironic is the right thing, but it's kind of funny. To me, it's kind of ironic that, right, we're saying, how do we build trust? At the same time, what we're saying with this is, more than ever before, we're putting the consumer front and center so that they can trust us, and that we're trying to be as transparent as possible. So I think there's sort of a gap, a cognitive gap, if you will, of, I think that, what we're doing here, the standards are advancing. We are treating this, in the same way that we would treat, credit data. We are putting the consumer at the forefront. But because this is still in its infancy, if you will, there's a road ahead of us to educate consumers on this. And so at Experian, we have a direct-to-consumer channel that is a platform to educate consumers, where consumers can come in and they can view their data. Our consumer channel, of course, is very keenly interested in this. When we talk about this, it just isn't a B2B play where we're trying to get this in the hands of lenders, but we're looking at it comprehensively and saying, again, we need to educate consumers. How do we do it? Okay, well, we've got a direct-to-consumer platform. We were talking last week about putting together sort of a separate, maybe three-way site that we all manage, right? That we can educate consumers on. But that's what needs to take place. And maybe there's some badging. I don't know. Maybe just like you go to a website, right, and it shows that it's HTTPS, it's secure, or it's Better Business Bureau, or that it's a national credit bureau that's doing this and not some fly-by-night aggregation company that who knows what they're going to do with your data, right? That is meaningful as well.
Yeah. I'm glad you ended remarks on the consumer education piece, because this whole notion of thinking about just sort of the need for or what consumers are going to need to understand about what they're doing. So consumer education, financial literacy training, more in the counseling realm about how this works. I think those are things, as this is developing and evolving, are really things that we have to take very seriously in terms of how we educate and have people understand what's happening. I want to turn it to all of you. I know we have what a great audience we have of people that care a lot about these issues. Would love to hear some of the questions from your vantage point. I'll start. I want to start with Barrett.
Thank you. So Dave, one of the advantages of credit file data. Oh, sorry. One of the advantages.
Announce yourselves.
I'm Barrett Burns from Vantage Score Solutions. One of the advantages of credit file data is that it's highly structured and highly regulated, and therefore it's easy to test for discriminatory issues and disparate impact. So 2 questions. One, related. So will this checking account data, for example, sit in a regulated credit file that the CFPB can audit? And the second thing is, and you touched on, this goes to adverse action, you touched on reason code. So if somebody's turned down, somebody has a good credit score, is verified by lots of free sources, and they get through the initial screen on the automated systems with the GSEs, but they get turned down for checking account data. Well, is that subject to reason codes and fair lending testing, disparate impact, and so forth?
So it is subject to reason codes, and we have created reason codes for that. It is, the reason codes are returned just as they would for traditional credit data. And I think one of the exciting things about this is that we see that, as Nick mentioned, that as we look at those consumers that currently are unbanked or underbanked, and here we're really talking about underbanked because by definition these are consumers that have a checking or savings account type relationship. By definition, this is all positive information. This is information that is acquired through data aggregation. So if an account is closed down, we can't access it through data aggregation. So this is all positive information, many positive type financial behaviors that were previously invisible, and now we're bringing them into light. What we've seen is that the majority of consumers do experience a positive impact from this. And,
I'm talking about turn down.
and in terms of turn down, in terms of disparate, in terms of, I'm sorry, can you clarify your question?
That data results in a turn down.
So reason codes are returned as part of this. And with respect to holding that information, that is something that Experian does when it's used as, when a credit report is created using the DDA type data.
Yeah, so again, that's treated as a FCRA, credit report or consumer report. And so that's when I was speaking to the remediation that a consumer would have. They could contact our national center where, we have a separate report, so it's not commingled with the traditional credit file. It stands on its own. So again, Finicity is a CRA. So that report is delivered, it's stored for audit purposes, and or if a consumer needs to call in and file a dispute. Yeah, so it's treated that way.
Okay. Great. Yes, sir.
So I wish this was like a whole day
Your name,
seminar.
please, name.
My name is Abdul Ahmed, formerly with the World Bank, now with Virginia Tech. My question is for David, and it's about the DDA analysis work that you did. Did you just confirm what you were looking for? In other words, what was the baseline with which you validated those who do not have FICO, those who are not visible.
Sure.
My second question is for Finicity, and it's about the data granularity that you provide to others. So let's say some moral guy from somewhere in the world says, I want to find out those who are buying liquor and just, so I'm socially responsible and want to ban them. You know, if they want to ban something like that, if you could speak to that in terms of GDPR or similar regulations, so to speak.
Sure. So I can address the first part of that. Yeah, so with respect to the, there was some hypothesis testing. And to be clear, banks have been using this type of data for their own internal modeling for many years. So this wasn't too much of a surprise that we saw these relationships. What was critical for us, though, is that we were able to look at these relationships across a national perspective as opposed to just what a bank has on book. So we're able to draw these relationships between, for example, not bouncing lots of checks on your checking account across a very large national selection of consumers. So we're able to find those relationships. And for those consumers that weren't scoreable, we are able to still see there's still a segment of those consumers that still obtain some type of credit. And we are able to go back and look at the relationships of that DDA data and credit data and how that relates to their performance on those credit obligations over a period of time. And we can look at patterns in that data that can help us score the unscorable. And again, going back to financial inclusion, that was a very positive thing for us. Yes, yes. And one thing that was brought up is while we are focused on DDA data today, there was a comment about prepayment data. And we feel that is critical, especially for certain pockets of the population. And we're working now to try to obtain those types of data sources for model development.
And then relative to the creation of the report, so we generate a report using the raw data, and we generate characteristics and attributes on top of that and deliver that into the model. And so the model takes into account the characteristics that have been generated on top of the raw data and are not inclusive of the raw data.
So you would not be able to see liquor purchase. You would not have the detail on the transaction level as to what someone was purchasing and where they were purchasing things and
Exactly.
that kind of thing. Okay. Thank you. Lori?
Yeah, thank you. Thanks, Lori Goodman, Urban Institute. So for most people, their single largest payment each month, most people who are renters, their single largest payment each month is their rental payment. On average, over the course of a year, that's 30% of their income at the median. I'm actually somewhat surprised, or at least, or actually, I guess as a question, have you looked separately at rental payments? I mean, it requires you to actually extract the payment history and identify what's a rental payment. But as I'm looking at sort of your results, the differences in credit scores are, I mean, they're significant, and I'm sure that they're smaller for, I'm sure they're larger for lower credit scores. But, you know, it sort of seems that someone who's got 2 years of a very clean rental history, that could be worth 20 or 30 or 40 points on credit score, and just wondered if you'd looked at that.
Sure. And short answer is we did not as part of this analysis. It raises the question, where do you draw the line in terms of that transaction detail? It's something we could potentially look at down the road, but not for this type of study. And just to follow up on your comment, some of the analysis that we're looking in terms of score difference, that's looking at the aggregate, that's looking at the entire population. We certainly see significant differences, especially those consumers that have very thin or young files. That's where we see the positive impact.
I think we have time for one more question in the back.
Hi there, Jay Jang with the American Bankers Association. So I wanted to direct this question to Nick and David about the fair lending and UDAP risks associated with alternative credit scoring models. So, you know, I wonder, you know, there is some concern about the use of certain data points that may serve as proxies for protected classes under fair lending laws, like national origin, race. What are the dangers of that? How can you really make sure in a proprietary and black box model, in a sense, when you're dealing with these alternative credit scoring models, how do you make sure you guard against that? I don't think it's beyond the imagination where, if you get that wrong, that could worsen financial inequities as it exists, or possibly even exacerbate how they exist today.
Sure. Sure. And short answer to that is that we do have to undertake analysis. I think that's important. The lenders that we work with, that's part and parcel of what they undertake in terms of adoption of any type of credit score. Again, I think the way that this score is currently being used, especially in pilot, is that it's being offered in most circumstances as a second chance type score. So we're looking at consumers that have already been declined. And is there an opportunity to, instead of saying, wait, I'm not going to give you the credit that you're seeking, but perhaps if you're willing to share additional information with me, I can perhaps gain a greater insight into your situation, potentially give you the credit that you are seeking. So it's a means of teasing out positive information that currently is invisible. And I think that has the potential to impact across the board.
And I'll make one comment, is that when you think about this bank data, consumers have been submitting bank statements for loan underwriting for decades. This is not really alternative data, it's the same data, but just in digital form. And so lenders have been doing some analysis on the statements that have been provided. And so we think about this not necessarily as alternative data, because it truly is just pure cash flow, which is fundamental, as you talked about, to making a good decision.
I think that that's a great point to end on. We could have, as this young man mentioned, another few hours of conversation on this, and alternative data being a whole nother session to talk about utility payments and all other kinds of payments that are not DDA that could or should or maybe would impact credit decisioning in the future. So with that, we'll wrap it up, and I'd like to thank the panel. Please join me in thanking the panel for a great conversation. I'd like to thank FICO for sponsoring this morning's event. And having it here at the Urban Institute for what is an important conversation that I believe we're in the beginning phases of, folks. I'm glad you're here today, but I think there's a lot more conversation that we're going to be hearing about from the regulatory standpoint, all the concerns, the consumer issues, privacy, security. This is, we're sort of breaking ground here on this conversation that I think all of us will be a part of going forward. So thanks again. Have a great day.